stock of supermicrocomputer today. I'll immediately show you a fail-safe strategy where we earn regardless of which direction the price moves. Let's break down this stock as thoroughly as possible. Let's start from the very beginning. Over the last 2 months, supermicrocomputer has seen a significant surge, nearly 300% growth. However, over the past month, we've been in a consolidation phase. There have been 37 days where nothing much has happened. But I want to draw your attention to a gigantic volatility. Just look at the cost of options. Even the nearest one, that is $1,500 worth of option sales, amounts to $400. This is certainly a lot, and consequently all the premiums are decaying over time. Okay, I'll touch on this a bit later. Let's start with volatility right away. What's happening there? We'll need to pay very close attention to this because I base my strategies heavily on volatility analysis results. At the moment, volatility is around 80%, ranging from 70 to 90%. This is very high volatility, especially for a stock that's priced at $1,500. I remind you, it's supermicrocomputer. Now it's part of the SP 500 index. Let's look at the volatility smile. We can see that the nearest strikes have lower volatility, and mostly, of course, towards the increase. Towards the calls, the volatility isn't rising. We see that it's mostly a flat line. But towards the decrease, towards the puts, we see volatility starting to increase. Generally, this is a normal situation when volatility is skewed towards the downside for puts because investors and traders hedge all their purchase stocks using puts. But at the moment, due to such enormous volatility, it's certainly not recommended to do so. Let's look at the historical and implied volatility. Historical is the gray line. Implied volatility is the white line. At the moment, the implied volatility is much lower than its historical values. But I want to say that sooner or later, historical volatility will come down to implied volatility rather than the other way around. I remind you that sooner or later, these volatilities must converge because that's how the market works. But mostly, our implied volatility tends towards historical. But here, the historical volatility is very high. The stock is now more stable because it has entered the SP 500 index. And naturally, I assume that over time, historical volatility will gradually decrease. So in general, volatility will be lower. Consequently, historical data will also be lower. Let's look at the trading volume of options, a very important chart. I always show this, it always needs attention. As we can see, a very large volume is concentrated at the $1,000 level. Also, we have at $1,200 and $1,300. What about the calls? For puts, we have $1,000, $900, and $800. I would like to draw attention to the volume of trades in the coming weeks, as we can see the green color. The color represents options expiring on April 5th, meaning the vast majority of options expire in a week, in 2 weeks. Of course, this is very bad for stability. The more skewed the options are towards the nearest expiration, the less stable the stock behaves, and it can move very sharply, unpredictably, because all these options will need to be hedged. I just want to say that these options have a very, very high gamma. Remember that the closer we are to the expiration of these options, the higher the gamma, and any change can prompt market makers to change their positions. Let's immediately focus on this huge wall at $1,000. Let me remind you again how market makers work. All investors and traders who buy options, on the other side, we have a market maker who sells you options, but he earns not on selling options, but on commissions and spreads between options. For example, with this stock, the spread is almost $100, but when the market opens, it may be smaller. In any case, if the volumes are very large, this is where the market maker makes money. But you see, if he sold you an option, therefore you have an open position. If the stock is expected to rise, therefore he must hedge his sold option. He does this using a delta neutral strategy, meaning he buys the amount of shares equal to the delta. This is a dynamic strategy, meaning with each price movement, there is a rebalancing of the market maker. Therefore, we may experience a certain gamma spike. So when the stock is expected to rise, the market maker starts buying as many shares as possible to hedge this rise. This pushes the stock up, and it can continue until some large player wants to sell their shares, and then this movement may stop. And of course, the more shares we have in the bull market, the more all these options burn, and the more the market maker will have to sell the shares he previously bought. I remind you, of course, we have a very large volume of calls, but we also have a very large volume of purchased options for the week. But if you keep buying options for a week each time, and they don't make you money, obviously, sooner or later, you'll run out of money. And personally, in my opinion, this cannot last long. Before we look at the stock, I'll still show you my strategy that I've put together. Look, if the stock stays at $1,000, we'll make $8,000. If the stock rises to $1,250, we'll be making $30,000. If the stock drops to $840, we make $24,000. You understand the logic. Here we make money anyway, no matter where the stock goes. This is a very, very important point. I always try to explain this to you. The most important thing is position management. I also strongly advise against opening this position because it requires very skillful management. You have to buy options, sell options, you have to hedge your position. Under no circumstances do I recommend opening this position. Only professionals can do this. What could happen here? Personally, I've already mentioned that the profit potential here is limited, and the potential for growth is coming to an end. Overall, the expected value and risk-return ratio are not in the investor's favor. I'm saying right now that the stock could rise to $1,000, even $1,200. But how much will you make on this? Not much. But the stock could plummet very, very strongly. In general, I'm not buying this stock, but I don't have it in my portfolio. And at the moment, I wouldn't risk buying it. Again, it could grow, of course, but with the risk-return ratio not in your favor, you simply need to understand this. And just a reminder of my philosophy, I don't know where the stock will go. I have no idea. The most important thing I know how to do is manage positions skillfully. Here's how I'm already showing you. You need to build a strategy so that no matter where the stock goes, you're making money. That's the secret to success. That's it? You think big banks can predict price movements? No, they just have a well-managed portfolio. They manage positions so that they make money in any case. That's the secret. It's just a secret. I'm just opening your eyes to reality. Remember this and you'll make money. In addition to this, of course, you need to consider the mathematics and the risk-return ratio. But again, here, pure mathematics just works. This is regarding more medium-term trading. If, of course, you're buying a stock for 10 years and beyond, then undoubtedly, in 10 years, it could be worth $3,000, $4,000. No problem, but are you ready to endure a downturn? For example, when stocks fall back to $300, will you not sell? And are you ready to sit for 10 years? If yes, then of course you can buy at these levels. But I would prefer to buy much, much cheaper. Why buy expensive when you can buy cheaply? And once again, I want to say, I'm saying that the stock is good, the stock is profitable. As we can see, it has been included in the SP 500. Profits, revenue are growing at very good rates. No one is disputing that. It's solely about the price. It's just expensive. And the stock is very good, but expensive. I would gladly buy it if it fell. That's my logic. That's my position. Also, I want to remind you that in the near future, I will launch an experiment. I will create a new account, absolutely clean. We will earn and build a portfolio from scratch. There won't be anything there. I plan to fund it with monetization from YouTube. I think it will bring in $50 to $100 a month. This is a little that anyone can afford. And there I will show you the logic of building positions. Everything will be absolutely transparent. I will show all my accounts, all the numbers, how I open positions as well. I will create an absolutely public spreadsheet. You will be able to access it, check it at any time. Which stocks I have, which I don't. This portfolio will definitely outperform the SP 500, my signature strategy. So subscribe not to miss the start of this experiment. Let's get back to the stock. In a month, we'll have a report. We'll definitely look into it. But again, personally, in my view, the potential for growth of this stock price is clearly limited. And I, of course, will wait for it to drop below to consider buying or just not touching this stock at all. We'll just have to watch and wait. I also advise you to watch my previous video. Regarding this company, I also make forecasts there. So far, everything is going exactly according to plan, as I mentioned.